Episode 4, How Canadian Banks Really Make Money, and where you're losing it. By the end of this video, you'll understand how Canadian banks actually make their money and how to avoid quietly losing yours through everyday habits most people never question. Most Canadians use banks every single day. Your paycheck goes in. Your bills go out. Your money moves automatically. But very few people understand what's happening behind the scenes. Banks don't make most of their money by helping you save. They make money by controlling how you move, store, and borrow money. Once you understand that, the system becomes much clearer. This episode isn't about blaming banks. It's about understanding the rules of the system you're already in. When you understand the rules, you stop losing money by default. Canada has one of the most concentrated banking systems in the developed world. A small number of very large banks control most personal banking. That structure matters. Less competition usually means similar fees, similar rules, and very little pressure to lower costs. Banks don't need to trick customers. They just need customers to stay comfortable and passive. Most people open a bank account early in life and never question it again. They don't compare options. They don't read fee schedules. They don't switch unless something goes very wrong. The system is designed around that behavior. Let's start with checking accounts. Checking accounts are the most common banking product in Canada. They're also where most people quietly lose money. Checking accounts are designed for transactions, not for saving or growing wealth. Money comes in. Money goes out. Banks make money on checking accounts through monthly account fees. Some banks charge just for having the account. Some charge per transaction. Some charge if your balance drops below a minimum. Individually, these fees don't feel dangerous. Over time, they add up to hundreds or even thousands of dollars. Now let's talk about overdraft. Overdraft is often marketed as protection. It sounds helpful. In reality, overdraft is a short-term loan with penalties. You didn't apply for it. You didn't negotiate the interest rate. But you're charged for it anyway. One small timing mistake can trigger multiple fees. Especially when several payments hit your account at once. Overdraft is one of the most profitable features in retail banking. Not because it's expensive once, but because it happens repeatedly. Checking accounts should be boring, cheap, simple, functional. If your checking account feels complicated or expensive, you're subsidizing the system. Now let's talk about savings accounts. Savings accounts feel responsible. They feel safe. They feel like the right thing to do. But safety and effectiveness are not the same thing. Many standard savings accounts pay interest that is lower than inflation. That means your money slowly loses purchasing power every year. Quietly. Your balance might increase, but what that money can actually buy goes down. High interest savings accounts are better. But they are not magic. Many rely on promotional rates that expire. Some limit withdrawals. Terms can change. Savings accounts have a role. Emergency funds. Short-term goals. Cash buffers. They are not wealth-building tools. Treating them like investments is a common mistake. Now let's move to registered accounts. TFSA. RRSP. RESP. These accounts are often spoken about like investments. They are not investments. They are tax containers. The account itself does nothing. What matters is what you put inside the account. The investments. The fees. The structure. Banks profit from confusion here. They sell convenience. Prepackaged solutions. Hands-off products. In exchange, many people accept higher fees and lower long-term returns, simply because they didn't know what questions to ask. Understanding the difference between a container and an investment is one of the biggest financial upgrades available in Canada. Now let's talk about fees. Fees are the quiet engine of bank profits. They work because they feel small. $5 here. $10 there. Amounts that don't feel urgent. But fees compound just like interest. Over time, they add up to thousands of dollars. Money that leaves quietly and often goes unnoticed. Banks rely on routine. They rely on people not checking statements closely. Here's the mindset shift. Your personal finances are a small business. Every account is a tool. Every fee is an expense. Business owners track expenses carefully. Most people don't apply that same discipline to their own money. But they should. Banks don't rely on greed. They rely on habit. People stay where they started. They accept defaults. They confuse convenience with value. Smart Canadians don't fight banks. They understand them. They minimize fees. They separate storage from growth. They question default options. They switch when it makes sense. They treat banking as infrastructure, not identity or loyalty. If you're subscribed to this channel, you're getting these breakdowns before we turn them into deeper tools, checklists, and step-by-step guides. Subscribers influence what gets built next. That's the advantage of being early. Let's bring everything together. Checking accounts are for movement, not storage. Savings accounts are for safety, not growth. Registered accounts are containers, not investments. Fees are never small when they repeat. Banks optimize for profit. You must optimize for awareness. Once you understand the system, you stop overpaying for convenience and start using banks as tools. Before you go, subscribe and like this video. Leave a comment. Tell us what bank product confuses you most. Tell us what fee surprised you. We read the comments. We listen. And we build this series around what you ask for. Next episode, we're breaking down interest in Canada, how it works and why it's either helping you or hurting you. This is how money works in Canada. We don't guess. We understand the system.